All right, so I want to get your perspective. The estimate is 155,000 jobs added, wage growth of 4% year over year. What does that say to you about the economy? How do you think the Fed reads that if we hit those estimates when they're making their decision later this month?
I think it all says that the labor market's very healthy and the U.S. economy is doing fine. I really do believe we are at full employment. So anything north of 100,000 is probably really strong. Again, 100,000 was kind of break-even payrolls level that you needed back before the pandemic to have full employment. That number might be a little bit lower, especially given the fact that companies are retaining more of their workers because of retirements. But I think the labor market is strong.
All right. So you say the labor market is strong. There's something that you're looking at. I want to get your take on it. So you're looking at the unemployment rate. So the unemployment rate for 27 weeks is over. You say it's ticked up from 0.74% in early 2024, and now it's about 1%, at least at the last reading in November. I mean, 0.3%. Why is that important?
Well, I mean, the highest it's ever really been in the last 20, 30 years was 4.5%. And that was certainly during the pandemic. Actually, no, it was during the Great Recession. So there is some relevance here. The point is that it's up. And I think a lot of that reflects people who were jumping back into the labor market. Either they're new to the labor market or they're re-entering at a time where there just aren't that many jobs to go around. Remember, companies gutted their workforces during the pandemic, and they spent about 3 years getting those people back to the office. Well, those people are back. And the thing is that it's just more difficult. So anyone who's kind of coming in at this late stage is going to find it more difficult to find employment. And so I think, anyone who's run out of their unemployment insurance, which lasts for 27 weeks, and they can't find a job, I think that's the frictional unemployment we're going to see. But when you look at the level of payrolls, it's extremely high. And I think most people who want a job have a job.
All right, I want to go to that wage growth, 4% year over year. You say labor costs are a problem right now. Why are they a problem? Don't we want a strong consumer to continue to power the economy and, by default, the stock market as well? Don't we want to see strong income growth for people because they're going to go out, they're going to consume, they're going to buy cars, and it's going to also help them kind of weather these higher interest rates overall?
Well, it's really about perspective. Absolutely, we want people to feel secure. And certainly wages are much higher now than they were pre-pandemic. And that is fueling consumption. We saw, everyone was afraid of a recession in 2023 and weakness in 24. We didn't see that because consumers are working, wages were higher, they had savings, and they had a reason to spend, especially on services. However, it does mean that inflation is higher. We think that for companies, those wage costs they're just passing it on to the customer, and certainly that's causing inflation, especially for core services, and that feeds into what the Fed's going to do with interest rates. When you look at what's driving inflation on the services side, absolutely, it's housing, it's insurance costs, but it's also those wage pressures. So it's good and bad. And we think that as long as you continue to see those types of pressures, that the Fed is going to remain on the sidelines and say, look, we don't need to cut interest rates that much. We need to be gradual with this. And that's where they're going to head.